This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. My name is Mike Maroney. I'm coming to you today from the Monex Precious Metals studio, and it's Friday, February 5th, the Friday before Super Bowl Sunday. The interesting thing about the marketplace is sometimes you have players that haven't been involved in a specific arena start to look at a new possibility as far as investment choices are concerned. And when they do, a lot of times what they'll have is very good questions. And yesterday I had an opportunity to have lunch with a friend that's a trader for one of the large hedge funds here in California. Now, he's typically involved in the stock market, and I've been trying to get a lunch with him for quite some time, but I got a call out of the blue and he invited me to lunch, and lo and behold, he wanted to ask me some questions about the precious metals markets. Now, could it be because gold is the number one performing asset so far this year? Or could it be that large money is starting to look at the precious metals market as a possible alternative? But I went to lunch and I was pleasantly surprised that they were looking at this arena as a possible investment choice, but he had some basic questions because typically he invests in stocks. And he started off with some questions about commodities in general. And he asked, what are the three basics as far as commodities are concerned? Now, I said, typically like any other commodity or any other investment, it's important to understand basic supply and demand. And when you think about commodities, normally you talk a little bit about equilibrium, cost to produce, and then you have the simple fact, is big money moving in or is big money moving out? Let's address those three subjects. First of all, supply and demand. Now, supply is typically driven by price. And in the commodity world, when prices go way up, supply has a tendency to come out of the woodwork. Now, in the precious metals world, it is very difficult to flip a switch and suddenly have supply come online. But when prices go up and maintain high levels for years and years, that supply gets pushed into the market. Now, what we saw when gold was trading at over 1900 and silver was trading very close to 50 is we saw a build-up as far as supply was concerned. We saw a lot of new money go into exploration, as many of the mines thought that they would be able to supply the market at these high price levels, and they would be able to bring this new production into play. But what they found is it took years and years to do so, and unfortunately from 2011 all the way to 2015, we did not maintain that price. So a lot of these projects were mothballed or basically stopped because the mines didn't have the finances and they didn't have the price levels that they needed to support that new production. So what we've actually seen is a situation where gold has gone from 1900, it hit a low of 1045 in 2015. Silver went from a high of approximately 50 all the way down to 13. And what we've seen is the supply hasn't come on the market like many people thought it would, but the demand has actually remained very strong. Matter of fact, in the silver market, and this is just a microcosm, if you look at the demand for silver American Eagles, and a lot of people look at that and say, that gives you an idea of what the man on the street is doing. We saw the highest demand level in history for silver American Eagles in 2015. And the interesting part about that is from July on, they could have sold millions more coins, but they actually had to ration it out because they didn't have enough coins to meet demand. So the basic of commodity, supply and demand. Supply is tightening, demand continues to increase. Very positive signal. Now, equilibrium. Equilibrium is a nice word for price to produce. Now, there's a range as far as price to produce when you're talking about silver and you're talking about gold. But what you do is you kind of put everything together and you get a general area where the price is approximately what it costs the mines all in to get it out and take it to market. And if you look at gold, the price to produce is somewhere between $980 to as high as $1,200. So that's why when the price was down at $1045, you can imagine what we saw is we actually saw the mines come into the market and buy. People think, why would a mine buy? Well, a mine bought because when it was at 13, 14, or 1500, they sold. And they didn't have to deliver for 6 months, a year, 2 years out. But instead of mining and delivering that $1,500 and $1,400 gold, when the price dropped below $1,100, they come into the market and buy from the market, deliver against those contracts. They don't even have to use their reserves, and they make a nice profit. But when the commercials or the miners start to buy back their forward, that's usually a really strong signal that the market's very close to a bottom. So gold, $980, $1,200. Silver, somewhere between $12.50 to $14. Silver traded as low as $13.62. Once again, very close to what? Cost to produce. So there's a saying that it's hard to get hurt falling out of the basement window. And what that basically means, if you buy real low, there's a good chance it can't go much lower. And that's kind of what we were looking at as far as precious metals. Now, when you look at big money has a tendency to move in and out at the right time. And one of the reasons they move in and out at the right time is when they move in, they make it the right time. And then when they move out, they make it the right time to be out. And what we saw back in 2011, 2012, big money started to move out. And what we're seeing right now is that money is starting to come back in. So supply and demand, equilibrium, and big money, all in our favor. Now, we brought up 5 key catalysts that he felt would be very important to understand as far as silver and gold. The first thing was negative interest rates. Negative interest rates are when Japan, Australia, China, Europe, not China right now, the banks are actually charging money to put money in a bank. Now, this is usually very positive because there's an opportunity cost to owning precious metals. If you own precious metals, that's money you could have had somewhere else that may have been giving you a yield. When you're not getting a yield on your money, there's no opportunity cost to own gold and silver, so it makes it a much safer bet. And negative interest rates also affect how central banks act. If Japan and Europe are going negative, what is the likelihood that the US Fed will continue to raise rates? And that is why just this week, the dollar dropped 4%, and we saw gold and silver rally very nicely over the course of those 4 days while the dollar was dropping. The theory is that most traders had actually factored in 3 interest rate increases for 2016. Suddenly, that perception changed, where now people were looking and saying Japan's going negative, Europe's going negative, Canada's going negative. There's no way we're going to continue to raise rates. And a lot of people believe inevitably we will see negative rates here in the United States. So that is a very key feature. One of the other things we talked about was sector rotation. He wanted to know if a lot of big money was saying that they were selling stocks and they were converting into gold and silver. And what we've heard from the last 6 to 12 months is that we really haven't seen a lot of depth in the rally that's taken place in the stock market. If you look at the S&P 500, there's 500 stocks. That's why they call it that. And all of the gains last year in the S&P 500 were predicated on 4 stocks. They call it FANG. It was Facebook, Amazon, Netflix, and Google. Now, if only 4 stocks gave you all of the return in a group of 500, what that's telling you is that you're not getting a cross-the-board type of rally, a very strong signal that the stock market is topping. And when the stock market tops, if you think about it, where else are you going to go when banks are paying such low interest rates? And the bond market right now, you're locking in bonds, a 30-year bond at about 3%. Unfortunately, in a 2 or 3% inflationary environment, it doesn't make sense to tie up your money for 30 years to make 1 or 0.5% based on the cost of money and inflation. So of course, we're definitely starting to see classic sector rotation. Now, one of the other things he was curious about was the long-term technicals. And a lot of that is predicated on moving averages and basic Fibonacci's, which is a standard mathematical equation that gives you where support levels should come in based on a 38%, 50, 61.8% corrective move. If you look at gold and you look at silver, the 1380 area was right on a Fibonacci support level, and in the gold market, the 1085 area was right on a key Fibonacci support level. We went down, we tested, those levels of support have held, and now we've broken back above the 100-day moving average in gold and silver. Gold broke above the 200-day moving average, and silver got very close today, trading at $15, and the 200-day is up around $15.12. If we can establish a solid base, there's an old saying, if you get a strong base, the higher you can race. And that's exactly what it looks like currently in precious metals. Now, we're also seeing a lot of safe haven money move in. And what's safe haven money? If you think about all the things that are happening in the world today, geopolitical uncertainty exists at an extreme level. Obviously, we have the Middle East, we have North Korea, we have a lot of things going on with Russia and in Syria. Any one of these issues could be the match that lights the fuse. And in this type of environment, when the geopolitical situation that exists in the world is so extreme, most investors look at minimum at a 5% holding level as far as precious metals, just for their catastrophic insurance. So with everything else that's going on, we're seeing sector rotation and more safe haven buying. This is once again supplying a strong underpinning. Now, last but not least, a lot of people believe that inflation drives the precious metals markets. But what a lot of people will tell you is it's really not inflation, it's faith. And it's faith in government across the board. And if you look at the sovereign debt crisis, and you think about the debt situation here in the United States, and you think about what's happening in Greece, and what's happening in Germany, and France, and Brazil, you wonder, how will the governments be able to pay this money back? There's an old saying that states that mathematics is like gravity. It's non-negotiable. And if you look at and break down the current state of affairs as far as debt to GDP or just debt levels in general, what we're looking at is a situation where really there's only one solution. You're going to have to monetize, or you're going to have to devalue your currency in order to pay it back. And whichever one takes place, it's very bullish for precious metals. So we agreed by the time we finish lunch that now may be one of the best times to own precious metals. The interesting thing, and one of the reasons we had this lunch, was back in 2002, I had called him and said, you know what, commodities are bottoming. I haven't talked to you about precious metals, and I've been doing it for a long time. I think now is a great time. Gold was at 250, silver was at 4. Gold went from 250 to 1900. Silver went from $4 to $50. But I actually believe right now with silver trading between 12 and 14 and gold trading somewhere between 1,000 and 1,200, now may even be a better time based on everything that's happening. Give us a call so one of our reps can explain these opportunities and we can get out some very special reports that we've had created by the CPM group. We want to share with you why owning precious metals in today's environment makes sense for your portfolio. Give us a call today. Thank you.